This video is educational, not financial or tax advice, to investors. Same $100,000, same decade. Same goal, one chose an 8% income fund. The other chose a plain index fund. At first, the income fund looked smarter. But 10 years later, the results shocked them. Sarah finished near $151,000 after 10 years. David finished near $227,100 over that decade. That gap came to roughly $76,100, and it reveals income is not wealth. First, let's define the kind of fund. This is not a high-yield savings account. It's not about individual dividend stock picking. This is about packaged income-focused investment funds. Funds labeled income, yield, or distribution solutions. They promise attractive cash payouts every year. Usually 7, 8, even 10%. The pitch sounds simple and very convincing. Generate income without touching your principal. So let's test that promise honestly. Meet Sarah and meet David. 10 years ago, both had $100,000 invested. Both wanted this money for retirement later. Sarah's advisor recommended an 8% distribution fund. The message was steady income and steady progress. The fund held dividends, REITs, and bonds. It looked diversified, professional, and dependable. And distributions arrived in Sarah's account regularly. She reinvested them, but loved seeing cash. It felt like proof the strategy worked. David chose a total market index fund. No exciting payouts, no clever strategy, just markets. Its annual fee was almost nothing. 4 years, Sarah felt smarter than David. David felt like he was doing nothing. In year 1, Sarah received roughly $8,000. David's fund paid only around $2,000. Sarah's income looked far more impressive. That psychological difference matters more than people expect. Cash arriving feels better than silent growth. But visible income is not the real score. The real score is total account growth. Sarah optimized for yield, not total return. Her fund paid cash but grew slowly. Sometimes it barely grew at all. Because much of its return got distributed. Distributed money stops compounding inside the investment. That's where long-term wealth slips away. Now consider the first hidden cost, fees. Sarah's fund charged 0.75% every year. David's index fund charged only 0.04%. Sarah paid nearly 19 times more in fees. That fee difference compounds against her yearly. Second hidden cost, return of capital. Not every distribution dollar is actual profit. Sometimes funds pay you with your own money. That looks like income, but isn't growth. Third hidden cost, annual tax drag. Sarah owed taxes on reinvested distributions yearly. David's growth mostly stayed inside the fund, so his yearly tax burden stayed much lower. Sarah's strategy had 3 forms of friction: higher fees, return of capital, and taxes. David's strategy had far less friction overall. Now look at what David actually owned. He owned a slice of the whole market. No manager tried engineering bigger-looking distributions. The fund simply tracked broad U.S. stocks. When markets rose, David rose with them. When markets fell, he fell with them. But lower friction preserved more of every gain. And preserved gains kept compounding into larger gains. That's why boring often beats exciting investments. Boring usually means cheaper, cleaner, and efficient. Now let's compare the actual 10-year outcomes. Sarah reinvested everything and still finished near $151,000. David reinvested everything and finished near $227,100. Same starting money. Same years, same reinvestment behavior. Yet David ended with $76,100 more wealth. That is a very different retirement outcome. Sarah was being paid. David was being built. Silent compounding beat visible distributions by a mile. The yield wasn't the advantage, it was the cost. So ask, what am I sacrificing for yield? Because in the end, math always tells truth. Subscribe and join Wealth Insider to test your numbers.